Let's talk about three companies that are way down, way down. They're down 50% or more over the last year. And when that happens, sometimes there's really great buying opportunities. So we're going to look at these three stocks, and I'm going to first give you kind of an overview of each one, what their big challenge is. They all have big challenges, and maybe what the opportunity is. Then we'll look at the numbers real quick. We'll look at a couple fundamental numbers. And then at the end of this video, I'm going to give you my recommendations on what to buy, what to maybe not buy. So we'll look at that too as well. So let's get started with the first one. Oh, and by the way, if you like this kind of stuff or want education around investing, do check out the courses and everything in the description below. And don't forget to subscribe as well. All right, so the first one. Meta, also known as Facebook. Originally Facebook, they changed their name to Meta. Now, if you look for them on the Wall Street Journal or anywhere, they're going to be Meta with is their name now is Meta. But they really are Facebook. Mark Zuckerberg, the whole group, they're Facebook. And Facebook, I don't love Facebook. I'm just tired of Facebook. I don't like all the shenanigans they do. I don't like the stuff they do with our data and all that and our invasion of privacy. But let's face it, they are the big player in social media, and that's one of their strengths. They fought off Google, basically when they tried to years ago try to compete with them on social media, and they couldn't, and they're still the biggest out there, like them or not. Now they've really took a hit because of things like Apple and some of the cell phone carriers are doing in concert with that around privacy. Which is a good thing I think it's a good thing for us as consumers, but it's a really, really bad thing for Facebook because, they can't target the ads as well, and thus they can't get as much advertising revenue. And if we're facing a recession, that's sometimes where some companies might pull back on their advertising, particularly, they look at their own return on investment. So that's been a real problem for Facebook, now known as Meta, and they've talked about that, and they're maybe looking at hiring freezes and stuff like that. And, so there's definitely, concern around that, and I would be definitely concerned around that too. Now, what's the big opportunity? Well, there's two big ones. One is the metaverse. They changed their name because they want to get in this virtual space and really be an early mover and a big player in metaverse, right? And you'll see in some of the fundamentals that we're going to look at in just a moment here with each of these three companies, they got a lot of cash on hand, so they can throw that money around. So if you believe in the metaverse, then Facebook's going to probably be well positioned for it. I said Facebook. Meta will be well positioned for it. The other thing too is they could do a better job of monetizing WhatsApp and Instagram, which Meta owns along with Facebook. And who knows, well, all that cash I have on hand, they might be able to buy another up and coming company or do something kind of unique too as well. So that's overview, quick thoughts on Meta. We'll look at the numbers in just a moment. The next one that's way down, like really down, that might be an opportunity is Coinbase. If you know Coinbase, they are a cryptocurrency exchange based in the United States and all that. And one thing I always liked about Coinbase, they always seem to be the most legitimate of exchanges out there. There's other good ones too, but they really pride themselves on security and keeping your Bitcoin and things you invest safe. And that's, one of their big strengths. And they went public not too long ago. I think it was less than a year ago. Maybe it was a little over a year ago. So they're still a young and up and coming company. And the thing with Coinbase, the negative, and then we'll talk about one of the positives, there's a lot of competition, and new competition is coming into the crypto space all the time. And new competition is coming from overseas or different places to compete for people who want to buy and trade and sell cryptocurrency. You could do it on Coinbase, but you could do it on Binance, you could do it on Bitfinex, you could do it on Kraken, and now other people are getting involved in it, like PayPal, for example, where you could go on PayPal and hold cryptocurrency and buy and sell some cryptocurrencies, a much more limited amount than, let's say, on Coinbase. But still, you're going against people like that as well as new competitors. So there's lots of competition, and they've had some new competition, well, not new, but competitors coming in, and it was Binance that just started kind of blew it all up and said, okay, we're going to have free trades on Bitcoin. They might expand that to some other coins too, and you're going to see these other exchanges have to match that, and that hurts Coinbase because their primary driver of income is through fees from trading. Now, one reason they give away these free trades is on things like Bitcoin. That's a lot of trades, that's free, but then some of the alternative coins or lesser known coins they'll still charge a fee on. But, there's other big players that could get involved in this space too, like Fidelity and Charles Schwab, even Vanguard. There is big money out there that if crypto really takes off could really, get in there if they want to, especially if regulation comes. And that's the other thing too that's Coinbase is facing. There's a lot of unknowns around regulation that's out there. There just was recently announced they're being investigated by the Securities and Exchange Commission around things about how they classify their instruments, whether it's whether it's a coin or a cryptocurrency, or is it a trading thing like a stock. For example, they have different rules. So I think they'll fight that up, but we don't know. So there's just a lot of stuff swirling around there. And then the opportunity there is also what's currently brought their stock down so much is the negative, and the opportunity is the same thing, which is cryptocurrency. They're tied so much to the value of cryptocurrency, particularly Bitcoin and Ethereum. So when Bitcoin is way down and all cryptocurrencies are way down like we're experiencing right now, that hurts Coinbase. People aren't trading as much, or they're getting out of the market. That hurts Coinbase. When cryptocurrencies are rising and there's a lot of fever and excitement around it, more people are getting involved, more people are trading, and so there's opportunity there. So you're really getting tied to the cryptocurrency space if you're looking at Coinbase. One thing to know is that there is a lot of room for cryptocurrency to go, because there's a lot of people still are not involved in cryptocurrency, so there's still more opportunity there. So it's a negative and a positive. And the last one is Netflix, right? So Netflix stock went way down because they missed what they were anticipating for subscribers, had a big miss in terms of a lot of people are leaving the platform, right? And their stock cratered, just crushed. And they also have lots of competition: Disney Plus, HBO Max, Amazon Prime, and every other type of creator of content seems to want to have their own streaming type service. So there's little bits of competition from little guys and bigger guys all the time, and you got big players certainly like Disney and Amazon, which are deep-pocketed big players. So that's a lot of stuff against Netflix. Now the advantage for them is they're still the big dog there. They're still the brand name and all that. Though they are losing market share, they're still an A+ player in terms of that streaming space. If they can fix things like around password sharing, and some of those people maybe we're getting free Netflix, like it, and now we'll pay, or if they work things in with a little bit of a commercial type option where they get money from advertising with different types of options, or just if they control their expenses better, there's a lot of upside then to Netflix too as well. In fact, 2 quarters ago, they had that big miss and their stock cratered. Last quarter, they had a miss, but it wasn't as bad. They lost subscribers, but it wasn't as bad as they thought, and their stock went up. So maybe they've come way down and there's an opportunity there. So let's take a quick look at some of the numbers for each one of these, just real quick numbers, and then I will tell you my thoughts on each one of these companies: buy, sell, or hold. Okay, I'm simply here at finance.yahoo.com, just looking at stock quotes. I've already pulled up Meta platforms, so let's look at them, then we'll look at Coinbase and Netflix. So you can see kind of what their price is, how they're doing, but I'm going to jump right to statistics. And I'm just going to highlight a few numbers. You'd want to do more due diligence than I'm going to do here, but I want to highlight a couple numbers and see what we see. One is, a good number to look at is the PEG ratio, which is related to what's the stock price related to its potential earnings and the growth of that earnings. So it's a little better than the price to earnings ratio, PE ratio, I think. So a PEG ratio is a good number to look at. And ideally, we'd like a PEG ratio to be under 1.0. That's what we're looking for, under 1.0. And for tech companies, they're rare to get under 1.0. They expect lots of growth. And if we look at Facebook here, I keep saying Facebook, oh my gosh, Meta, I'm sorry, Mark, I'm going to call it Mark Zuckerberg, I'm going to call it Facebook for a while. If we look at Meta here, right now they're about 1.03. That's very reasonable, especially for, a big tech company. You can see there's periods where they're like 0.88 and 0.94, but they're usually, I've seen them as high as 1.5 over 2, certainly in the early days of Meta. So that looks pretty good. Another quick number we'll look at is price to book. We'd like to see that anywhere from 1% to 3% if you're a value investor looking for something undervalued, well, not percent, but 1.0 to 3.0. Ideally, the best thing is under 1.0. The lower the number, the better. And so you think, well, their stock prices come down so far compared to their value of the company, their book value, that it would be well under 3.0, maybe in the range, maybe even really attractive, but it's not. It's a 3.72. If you look at back where they've been, over 7, 6, all this stuff. So they're coming down. But if you were a value investor saying, I'm looking at really attractive price to book type companies, this wouldn't be one. We look at quickly at their numbers, year to date, over the last year, they're down down 55%, let's call it 55%, versus the S&P 500, down only 7 since we had a little rebound from earlier in the year, 2022, and when everything started going down. So that's decent. The other thing that's nice about, and that's not decent, that's terrible. That's terrible. So that means there's an opportunity because the price has come down. But as we saw from these other two numbers, it's not super great, though that peg was decent. One thing too with some of these companies, especially like Facebook, I mean, they've got, if we look at total cash on hand, they've got $40 billion in cash. So they're not going out of business. They can invest in things. If they're putting everything on the metaverse, they have a lot of money they can throw at it. And yeah, are times tough right now for them? Sure. But if they pivot the company, that's the upside opportunity for you. Can they pay their bills? We look at like a current ratio, which is your, can they pay their current liabilities, looking at their current assets? You want that number to be above 1.0. They're well above 2.52. So they have no problem paying their bills because they've got all this cash on hand in addition to regular income coming in. So that might be some of the things to look at, but you want to do a deeper dive. None of these companies pay dividends, by the way, so we don't have to worry about, dividends as far as a consideration. I like dividends, but you don't have to worry about it as a consideration. All right, let's look quickly at Coinbase. All right, so now we're going to go to Coinbase. I'm going to stick in the statistics area here. Let's look at those same kind of measures. So they haven't had earnings, or they're losing money right now. They had some periods of earnings, so they had a below 1.0 price earnings growth. But when you start seeing NA, like in these forward price to earnings ratios, that means they're losing money at this current period. So so that's a consideration, right? Will they be able to turn that around, especially with the pressure with now free trades and stuff happening in other places? If we look at their price of sales, can be a good thing. You want that number to be lower. So if you're not having earnings, you can look at price of sales. That's not bad, especially compared to where they were, where people are paying real premiums for it, really betting on that cryptocurrency. So it's down following cryptocurrency that's gone down. Price to book, 2.13. That's in the range of 1 to 3. Is it below 1.0? No. But again, you're really betting on the future in this one. You might have some more downside than you would upside for a short period of time. We'll see how it goes. And how have they done the last year? Oh my gosh, down 73%. Could it go down further? Yeah, it can go down further. So don't look at that and say, oh, they must have bottomed out. They may have, but they can still go down further. So it's definitely down in price. Now, in terms of cash, they have a lot of cash, $6 billion, because they recently had their initial public offering or IPO and raised a ton of money. And now they're also pulling back on some of the new initiatives they're doing. They're also looking at freezing hiring, maybe letting some people go to control their expenses. So I think they're going to be okay. And their current ratio is good too at 1.55. So it's not like a lot of tech companies or younger tech companies that could be in trouble when things go bad because they just haven't established themselves enough. These guys are a little bit more established and have all that cash to pay their bills. So that's a good safety net type thing too as well. But here you're betting a lot, of course, on what's going to happen with cryptocurrency and how are they going to compete in the market. The last one, let's look at Netflix, and then I will give you my opinion. By the way, if you're liking this kind of stuff, don't forget to hit that subscribe button. So Netflix here, they've been around quite a while now. So their PEG ratio 2.12. So not super good with their price relative to their earnings. Even though their prices come down, they were way up there, especially coming right out of the pandemic or during the pandemic, the early days of the pandemic, and soon after, their stock went like a rocket, right? Because people are home watching all that, watching Netflix. But so their PEG ratio is not super great, not really that great at all. And their price to book, 5.09, that's not in an undervalued range, not even close. Not 3%'s like getting tight. There are a lot of people watching this who are going to say, see, I don't look at anything unless it's like 1.2 or below 1.0. So don't talk to me about 3.0. That's okay. But certainly if we say I'm going to look at this as a value play, an undervalued play at 5.09, no, it's not. Now, if we look back in their history, you can see, their price to book was 18, 19, just really, really high. And that came tumbling on down, unfortunately. In fact, if we look at their last year 52-week change, they're down 56%. And that's because they had a little bit of a rebound. They were down like 70% or 65 or something like that. They had a little bit of a rebound here in this last quarter where it was a bad quarter. They lost subscribers, but they didn't lose as many. And also, I think some people are liking what they're talking about as far as ways to improve the company that have been really kind of ignored for quite some time. Quickly, if we look at their cash on hand, we'd expect it. Yeah, they got $5.82 billion in cash, so they can weather a storm. When companies are down 50, 60, 70%, a lot of times it's because they're in trouble. They're going to go bankrupt or whatever. So that's why I like those kind of companies. Just check the cash real quick. And the current ratio. They're at 1.04, not a bad thing. They're still above 1.0, not as solid as the other two. And it's certainly if they control some expenses, they're going to be fine. And they're going to be able to raise debt if they had to pay their current bills, longer term debt. They're established, they'll be able to do that. But with interest rates rising, that's going to put more pressure on them if they have to raise debt. And again, no dividend like Coinbase or Meta, that I almost called Facebook again. All right, so there you have it. Those are these three companies. Just a quick look at the numbers. So, do your own due diligence more than I just did here. So, but based on what we just looked at and just thinking overall, let's look at these three companies. Let me rank them as far as what might be the better value or better buy, just quickly. In the number 3 position, I'm sorry, Coinbase, I have to put you there. I'd have to say Coinbase. Just still too much going on there. I'm very worried about this movement towards free trading. Robinhood has been successful with that because of or payment for order flow, and there's some other kind of tricky things they've done that helps with that. But even they're under a lot of pressure. You want to look at another company that's way down. Take a look at Robinhood, ticker symbol HOOD, which is a stock tracker type thing that also offers crypto now. So another competitor of Coinbase. So I'm just worried about that. And if I want to play more in the cryptocurrency space, then I might just buy cryptocurrency. So I put them in the number 3 spot. And I wouldn't buy it. I wouldn't recommend buying. And all these recommendations are more in my opinion than anything. And I just did this cursory look, so just think of it that way too. Netflix would be a number 2. I've always thought about buying Netflix, and I've always held off on it. I always thought they were overvalued for the longest time, at least over the last year or 2 years. And I might have missed out on a big run up, but I also missed out on the big downdraft, because when they went down like in a day, like I think it was like 40 or 50% a day. It was crazy. So I'm glad I missed that. However, I'm really concerned about and the reason was I thought they were a little overvalued, maybe more than a little overvalued, and I was always worried about competition with them and how they can differentiate themselves. Now, I'll be watching them closely, so they start seeing more profitability and they start getting subscribers back, or at least holding the line and then raising their profits by being more operationally sound. That might be very interesting to me. But right now, I've been kind of holding off on them. And then Meta, oh gosh, Meta, why do you make me put you number 1? Oh, why do you do it? I just think Meta, and I will call you Facebook, so much cash, so much dominance. Yeah, people are jumping off Facebook like crazy. Yeah, they've got privacy issues. Yeah, they've got, every month they're going to have some kind of controversy. But with that amount of cash, and if the metaverse does take off, they have the cash, and they've made this first movement in there, and they're committed to it. They're so committed to it, they changed the name of the company to Meta. They could be well positioned, but all these are risky plays, right? So maybe I'd buy some Facebook. I said again, some Meta, but gosh, I'd hate it. I almost feel dirty because I just don't like the whole privacy stuff with them. I wish if they improve that, I would like them better. By the way, if they improve that, but that's their whole thing. Their whole thing is data, right? And taking our privacy. That's what gives them their strength, is the data. So with that, there's 3 companies, so Facebook maybe, or Meta maybe. So there's 3 companies. Don't jump into them just because you think, oh, they're down so far, they can't go any down further, because they can. That's the thing. So any of these companies you're investing in, understand you're taking on a lot more volatility and possibly risk, but the upside could be very high for these companies. So if you want to take something that's a little more, I don't want to say speculative, but I want to say a little bit more risky, certainly a little bit more risky. These might be 3 companies to put on your watch list and follow a little closely. Okay, I hope you enjoyed this video. If you like these kind of videos, go ahead and hit that subscribe button. And don't forget, mostly what I do is full courses. So I have some free courses in the description, and I have some very long, complete pay courses around investing in stocks, crypto, metaverse, all sorts of stuff that I'm always creating. So do check that out as well. So with that, hey, do your due diligence, look closer, and maybe if anything, just put a smaller amount if you're not so sure if there's one of these types of stocks that you might want to invest in.